Europe and U.S. are off their session lows this morning. Oil as well. Yesterday we saw a huge sell-off in stocks and commodities as Treasury yields hit an all-time low. We were just talking about the 10-year yield dipping below 2% for the first time ever. Well, joining us now from the London trading floor is Robert Buckland. He's the Chief Global Equity Strategist at Citigroup Global Markets. Robert, thanks for joining us here on In the Loop this morning. I have to tell you, reading through your research, you're a little bit more bullish than I've seen recently. And I want you to explain the 20-20-20 rule, which I'm sure not many people have heard of. Usually it's the 80-20 rule we talk about.
Right. I mean, what we've done is go back and look at previous 20% corrections in equity markets. Afterwards, they either go up by another 20% or down by another 20%. The difference between the two is defined by whether we have a profits recession or not. And we don't think we are going to see a profits recession. They'll slow down profits, but they won't reverse and fall into recession, in which case we think the up 20% is the more likely thing to happen.
What is a profits recession? I mean, everyone knows what a recession is from an macroeconomic perspective, but what does that mean for companies specifically?
Well, what we think, we define a profits recession as being a year when corporate profits fall by 10% or more.
And that we have not seen clearly, but the second quarter earnings have been quite strong. Third quarter, though, do you anticipate that we will start to see a lot of guidance coming in from both company management as well as from other analysts looking for much lower earnings?
I think people are looking for a deceleration in earnings growth as opposed to a reversal in earnings, i.e. a recession. And we've got that in our forecast. But I think the market's now starting to price in something like a 15 to 20% collapse in profits next year. We just don't think that's going to happen.
So you're really looking for a 20% upswing from these points over the next 12 months?
Yeah, right.
What markets specifically? Is this true? Is your thesis going to hold throughout sort of the European region for the UK as well as for the US?
That's a sort of a global equity market call that we're making there, and of course there'll be tilts around that, but the main direction is going to be set for equity markets on a global basis. So if we're right on equity markets over the next 12 months, then that's clearly going to help the European stock market. It might lag because it's got its own problems. However, any kind of positive move like that for global markets would be good for European equities.
Is there one thing that has to happen that's critical for your thesis to sort of bear out?
The main thing is that the world economy doesn't tip over into a double-dip recession. Clearly, profits are going to be very sensitive to that. However, if the world economy just grinds along at the sort of pace that we're expecting, not great, but not disastrous, we think there's enough juice out there to generate okay profits growth next year.
And profit growth would look like what next year at this point? Have you brought down your estimates at all?
Yes, we have. I mean, our profit expectation for next year is now down at 8-9%. But the market, as I said, I think is factoring in something like down 15%. So we're looking for profits to decelerate from the 12-13% growth rate that we're likely to see this year, but not reverse in the way that the market seems to be pricing in.
You have a lot of conviction in what you're saying, but there seems to be so much uncertainty surrounding the fate of the banking sector. And if we don't have that in place, it seems as if that is the first thing to go, and it trickles through immediately through the rest of the economy, whether you're in developed nation or emerging markets. So what is it about the banking sector that gives you confidence that things aren't as bad as they seem?
I think, as we said with the 20-20-20 rule, at times like this, you have to have a look at the numbers, see how things pan out. And we think there's enough growth out there to keep the banking sector okay. There's enough liquidity out there from central banks in particular to protect the banking sector. And we don't need things to be really good. You don't need that because expectations are so low from here for markets to do okay.
And when you're hearing talk over in Europe, and we were hearing from Swiss financial regulators that we are starting to see credit markets seize up, does that not suggest that there's some real risk there that we could go into a scenario similar to what we saw during 2008 and 2009?
Of course, there's always the risks of things working out badly on the downside. However, we do still think that there is enough liquidity being put in place by central banks to stop that happening.
Is there a particular sector, Robert, that you think has been completely oversold or more oversold than the others at this point?
I mean, people if they're expecting the market to go up, are going to be drawn towards buying the financials, of course. But we'd actually prefer to buy into the more cyclically exposed, economically exposed companies like mining companies, which have been hit very hard in this downturn.
Do you have any particular names?
I can't mention names on this.
Okay, so you would say not the financials so much, but go into mining companies. What about consumer companies at this point, retail stocks? We've been talking about that a lot. We've seen a spate of earnings released.
Yeah, I mean, the retail sector has done a lot better than anyone would have expected over the last year or two. I do think the consumer is clearly going to be constrained by austerity measures that we see in the Western world, and therefore I'd rather buy companies with exposure into emerging markets, which mining companies give me, retailers don't.
All right, we're going to leave it there. Thank you, Robert, for joining us today. He's bullish on the mining sector, bullish overall, looking for 20% gains in the next 12 months globally. That was Robert Buckland, Chief Global Equity Strategist at Citigroup.